So leading when life is hard. We have 20 people register. We may have more people join in. I just want to, first of all, this poem is particularly relevant now. We'll post that on a resource page, the full thing. Our objectives for today are really, first of all, to reconnect. There's people that I haven't chatted with for a while, and now is a time more than ever when I want to see you guys and talk to you. Second is to share ideas. So I brought a couple of people to get some conversations, and then I want to hear from you as well. Third is to share resources. So we've got Claude has set up a resource page for us that's got information on both of these topics, which we will send you a link to tomorrow. Our agenda is simple. First, what direction are mortgage interest rates really headed? It seems like maybe down, but that might be wrong. And I've got Garth Chapman here to lead us in that. Secondly, how do we manage tenants in crisis? April 1st is coming up, but then after that, we've got May 1st coming up too. And I've asked Arlen Dolan to address that for us. And then we'll have a few minutes of conversation after each of these things. So I'm going to launch a poll here. I know there's a small group on, but what direction are mortgage interest rates headed in the next 6 months? So I'll leave that on your screen if you can find it, if you want to weigh in on that. We'll see where we go. So Garth, I'm going to turn it over to you. Are you ready to go? You have microphone on?
Thank you, Jeff. It is. Can everybody hear me all right?
Yes.
Yes. Good. So what I'd like to first do is just say that my crystal ball appears pretty faulty for the last 2 weeks. 2 weeks that seems like it's been a lifetime. Every day it's showing me a different future. So a little context around interest rates. Really what's going on right now is we have a liquidity crisis that's evolving that is similar to 2008. The capital markets have dried up and there are huge gaps that had to be filled. The Bank of Canada is meeting twice a week with the leadership of the big 6 banks. That's unprecedented. The cost of funds for the banks has risen sharply in the last 10 days. CMHC is now buying large volumes, tens of billions of dollars worth of mortgages in packages from the banks, which along with purchases by the central bank will shore up liquidity. That's their focus. And it seems to me that the government and CMHC and the central bank have sent very, very clear, strong messages that they will put whatever they have to into the economy to shore up liquidity and keep the banks moving and keep the economy functional. The latest being the federal government chipping in for small and mid-sized businesses with a 75% payroll share from the government. So we're going to be okay. And at the end of the day, what's the cost of all this is what we really don't know. The Bank of Canada has now lowered the overnight target rate 3 times by 0.5% each time. And this morning we wake up and see that the banks have indeed passed through the third of those 3. So our prime rate has gone from 3.95 to 2.45 in 2 weeks. That's good for people who have prime-derived loans, prime-derived mortgages, especially those who have, prime -1, you're sitting at 1.45 right now. So there's a paradox in all of this too. As we see the prime rates drop and all this liquidity being pumped in, and the first thing we saw over the first few days of this crisis was interest rates dropping significantly. Now they've gone back up over the last 10 days. So a couple of factoids. One is that the prime rate derives variable rate mortgages and HELOCs and personal lines of credit. Those loans are a function of prime. They're prime minus this or prime plus that. Fixed rates, however, are driven primarily by Government of Canada bond yields. And those this morning are at 0.573%. On this day a year ago, it was 2.5. And 2 years ago, 1.5. And 2 years ago, it was 2.5. So we are in some, a region of ultra low rates. Also, another factoid to consider on mortgages is that high ratio insured mortgage rates are lower than uninsured mortgage rates. And that's counterintuitive based on the inherent relative risks. And that comes about because of government changes made a couple of years ago. So variables are down by 1.5. High ratio insured are, have been prime less 1. We've lost those discounts. Basically, mortgages now are prime less 0 in large measure. So we've lost the discount. So we've lost 1.5% in the prime rate, but the discount has disappeared to the tune of about 1%. So we've really got a benefit of about 0.5% out of all that. And it all comes down to the cost to the banks of money is way up. Fixed rates have been wildly gyrating. And due to the above, that's where we're at. So where are we today? We have 3 charts. You can look at, I need to get rid of this poll that's on my screen here, sorry. So prime versus overnight, you'll see that in around 2000, there started to be a gap. There had not been one previously. So the overnight rate is the Bank of Canada rate. What that's telling us is in around 2000, the banks stopped passing through all of the decreases. And that was for the same reason as we're seeing issues now around the cost of funds for the banks. And the next slide is going to show us historical discounted 5-year variable rates. If you go back 40 years, the average variable rate was, or prime rate, I should say, was around 6%. If you add in the last 10, it's probably down around 4. But in the last 10 years, all by itself, if you look from 2010 on, we've ranged from 2 to a little less than 3% for that 10-year period. That's a very long period of extraordinarily low rates. Economists all over the world have been telling us for years this can't go on. Pension fund liabilities, et cetera, are going to be a huge issue, but it just keeps on going, and it is counterintuitive. Lastly, we have historical posted 5-year mortgage rates. Again, if you think about historically, average rates were around 6, but for the last 10 years plus, we're sitting well under 5. And these are the posted rates. So the actual rates are probably averaging in the last 10 years, 3% in that range, with many periods of time well below that, down into the low 2s. So Bank of Canada policy. The Bank of Canada has a mandate to keep inflation within a range, and that range is adjusted from time to time. I think now it's 2 to 2.5%. But for the foreseeable future, I think that may be off the table to some degree. Liquidity issues, I think, will be paramount. And that will last at least until our economy and that of our major trading partners is largely back up and running. Liquidity will be the big issue. Why might rates go up? Well, currently rates are up because of 3 real factors. Lenders just can't keep up with the volumes. March was the highest, I think, ever March in history for number of mortgage applications. This will return to near normal as the market dries up. The other problems that have been, in terms of lenders' ability to keep up, have also been, Scotiabank, 20,000 calls a day just on mortgage deferrals. And the third piece to this is the banks reduced staffing capacities, people working from home where they're not as efficient, and some people not working at all. So those 3 things have driven rates up. Next, I think it's about risk. Jeff sent me a little piece by Michael Campbell. And two key things came out of listening to that for me. What happens when lenders worry about midterm and long-term lending? Then you have no market because there's nobody lending. The second was, how can central banks keep interest rates low when increasing risk demands that they rise? It's like loading a spring. Will it take 1 month, 12 months, or 18 months? No one knows, but the risk is there. So his indication is rates have to go up. So what do we expect in the next 90 to 180 days? I think the discounts to variable on prime mortgages is gone for the foreseeable future. On fixed rates, I think they will settle back down for a period of time once these volume problems are over for the banks. And I think that'll happen fairly quickly, within a month. And as soon as we see enough of a settling down of this coronavirus that people are back out and active and buying properties, we'll see what is traditionally a spring market, which may not happen till the fall or till the summer. At that time, competition will drive rates down. At this point, lenders are reducing loan-to-value limits in various markets. Some lenders will and already have vacate various markets and or various product lines. One monoline's right out of the prairies. Another is out of uninsured lending in Alberta. And these things are driven by the bank's investors, in other words, where they get their capital from, backing away from perceived risks. And it's driven by monoline banks' capacities that are down due to reduced staffing levels, etc. So crystal ball, where is this going? We really don't know. We're in uncharted territory largely. Economies now around the world are so interconnected and there are so many moving parts. So at the end of the day, to me, this is, I think, what I take away from all this is cash is king. So preserve your cash. Take all payment and other deferrals, mortgage payment deferrals and other deferrals that you can get. Preserve available capital in your lines of credit. No one knows where interest rates are going, but rest assured they will go up and they will go down. The challenge is to know when and in what order.
Okay, thank you, Garth. So I'm going to end our poll, and we had one person set up, 50% flat and 40% down. I ran a poll on Twitter in the last few days. 46% said down, 30% flat, only 24% up. John Dyack is on this call. He's actually one of the inspirations for having this conversation. And I want to help him and me understand why we might be surprised that rates might be going up. And you all have unmuted microphones, so I'll share those results if I didn't. So there they are. And I would love to hear from anybody who's got some input. There's two ways you can do it. Chat, which Claude, I've lost my chat as well. Can people still see their chat?
Yes, okay. They can.
So
yes.
Claude, monitor that for me if you can, but everybody's microphones are open. We've only got 14 people on the call, so we can talk. And I'm grateful for all of you. You bring different perspectives. Garth is a mortgage broker and real estate investor. Arlen is a single multifamily real estate investor, been around for a long time. Jason is one of the best investment realtor brokers that I am aware of, and owns a large portfolio himself. Glenn kind of does the same in Ottawa. John is a dear friend, and Maureen there, hello.
Hello.
And Tara is from Calgary and has a ministry called Freedom Tree that looks after women in Sierra Leone to reduce maternal and infant mortality. But she manages a construction company as a real estate investor too. Pretty remarkable person. Brian, I'm just getting to know. And Brian, we haven't had coffee for a while. We need to, but I see you on social media and you're blown things up, so it's good. I want to catch up with you. Wayne Webster is a dear friend and mentor who owns multifamily property and student housing in Ontario, and is just finishing up a really amazing book on his life and how he built his real estate. I think the word empire might be in there, but I'm I'm really grateful. When's that coming out, Wayne? I've read.
I'm challenged with doing other things, and so I haven't moved it for the last 10 months now. But maybe one day.
So Claude is working with me on this. I've got Jamie and Tabani. I don't think I know, but I hope to get to know, and then some anonymous people as well. So what direction are interest rates heading? What kind of input? Anybody have any thoughts? I think what Garth shared with us is, this is the status quo. This is what affects mortgage rates, inflation, economic growth, monetary policy, the bond market, and the housing markets. That would lead us to believe that rates are going to be flat or go lower. But the Michael Campbell stuff, which we'll give you access to in resources tomorrow, which Garth presented, is that because of loan volume, liquidity problems, and increased risk, and the central banks are propping up the overnight lending. Question is, how long can that go on? And if it changes, it might not change slowly. It might change very quickly and catch us.
It almost always does change very quickly, Jeff. Good point. Very good point.
I think, Jeff, the thing that caught my attention when Maureen and I were at his conference was one of the speakers saying this is an unprecedented situation. And in the past, government has had the ability to push its shoulder against the issue and keep it in check. But the suspicion is the government will run out of the ability to do that. And that's why the tone in the room was, if you're going to look for risk management, this is one of the areas where you could be surprised when the government can no longer control this issue and can no longer flood the market with liquidity. It literally won't have the capacity, or, as we see the balance sheets of the countries, they get to a situation where risk is across the board. And that was kind of the tone of this conversation around why we should be looking at, will rates go up? It's mostly because the feeling in the room was the government won't be able to put a stop to it not happening like it has in the past.
I had a conversation recently, and it suggested that both the Bank of Canada and CMHC are going to be putting huge amounts of funding into to mortgages and making money, providing more liquidity in the market. Just huge numbers, unprecedented, wasn't even done in 2008.
So, Wayne, how long can they keep that up?
That's the $64 question, but they're throwing everything at the wall.
Yeah, it's great, Wayne, because one of the topics was just the number of people in Canada who have got significant leverage issues just day to day. The price of housing, it's really a perfect storm in Canada that people have bought homes and they're already extended all the way out with large mortgages. So that was the conversation. So I agree. And that was really the foundation for the risk profile in Canada, especially.
I'm always concerned when, and I know this is a small and educated group, but also the Twitter survey I did in different places, when everybody is complacent that things are going to pretty much stay the same, or yippee, rates went down. If we're in variable rates, I think, Garth, you said the lenders are passing those discounts along.
Yes,
Perfect.
all three of them. Yes.
But they don't have to.
No.
And if they've got loan volume problems, as you mentioned, that may be one way of slowing down the tide of people looking to make changes to mortgages. So what do we do? Do we lock in at fixed rates? Do we ride some of those variables? Those of us who have larger properties, how can we protect ourselves from a potential shock that nobody is expecting, which, by the way, is the world that we're living in right now. And that's the question.
Well, it depends really on the position, the situation you're in, and on your own liquidity and your own capacity. For most people these days, I mean, we have a $4.2 trillion mortgage market that grows by 10% a year. 75% of new mortgages are refinances and only 25% are purchases. Those are probably surprising numbers to some people. So largely the advice that the mortgage community seems to be centering on now is advising Canadians to who have a variable rate mortgage, likely with a big discount, ride it out, but watch carefully what's happening with the bond yields and what's happening with longer term fixed rates, and lock in when you think it's your time. Think of it like a stop loss order. Really, if you don't set criteria for when you're going to lock in, what you're going to do at what point, if you don't have numbers around that for criteria, you will make emotional decisions and you'll ride the train all the way into the ditch or all the way up the hill. So I think setting a stop loss order on your cost of money is important in terms of when you would lock in from a variable. And also when you would decide it's time to do an early renewal and grab rates and protect yourself for another 5 years or 10. 10-year rates, there have been, I haven't looked in the last few days, but there have been 10-year rates recently that are in the 3.5% to 4% range. So there's a way to protect yourself for 10 years if you can stomach 3.5% or 4% money. And historically, that's very cheap. Today it sounds high, but it's really not.
Okay. Garth, thank you. Everybody, thank you. I'm going to switch to the second topic, tenant crisis management. So obviously what we've just talked about, interest rates, is something we should track and watch. And I think the alert is be careful. It might not be going in the direction that everybody thinks it's going. And when it shifts, it might shift rapidly. And so we need to be prepared for that. Arlen, are you there?
Yeah.
Yeah. So
can you hear me?
I'll turn it over to you. So many of us have tenants, and their families are in crisis financially and otherwise. There's governments that are doing things that affect us, and we need to figure out how best to deal with them. So Arlen tuned me into some ideas on this, and he's going to share those with us quickly now.
I guess the first step is just to have a plan. Now, if you're self-managing, that's pretty straightforward. You can kind of create your own plan. If you have property management, you may want to be touching base with them to see if, one, they have a plan, which they most likely do, and two, if that's a plan that will actually work for you. Now, two, when you're talking to tenants, you want to make sure you empathize with tenants. That's going to really help. I mean, your tenants may be both scared and worried. In doing this, you actually have a chance to increase your goodwill and relationship with your tenants. And I would suggest if you are talking to them yourself, you should really talk in a slow, deep, and calming voice. Like don't be talking really fast like an auctioneer or you're all excited. You want them to stay calm, and one way to help them keep calm is for you to sound slow and calm and have a calming voice. Of course, one of the real important things to do is to also explain that the rent is still due. One thing you can do is you can remind your tenants that owners still have mortgage payments, taxes, and insurance payments to make also. And it's kind of like going to the gas station. Even though we're in the middle of a COVID crisis on our hands, we still got to pay for the gas for our vehicles. Now, as you know, you may have tenants that are laid off, reduced wages, all kinds of things could be going on. Now, here's where you want to help them find ways to pay. It could be simply just their unemployment insurance, but there are many other government programs, as we all know, and it seems like they're kind of changing on a day-to-day basis, and it's kind of our job, not necessarily our responsibility, but it'd be smart for us to keep on top of that and have those options for them. in case they don't know about them. But one of the things that we're doing also is we're giving them the option to use a credit card to pay for rent. And we're, to sound like we're working with them, because we actually are, we're actually offering them, we'll pay the credit card fee if they want to use their credit card. So they don't have, an extra fee on top of that paying their rent with a credit card. The other way is to also ask if they have any friends or family that they could temporarily borrow from for a rent payment. Now, fifth, there's going to be some tenants where they just, because of their situation, they simply can't pay the full month's rent. I mean, the way I look at it right now is, for the most part, April rent shouldn't be a problem. I mean, there's a lot of people that in late this month were laid off or lost their job and stuff like that, but that doesn't make them instantly out of money. May 1 is going to be more the concern. And, if you're talking to your tenants trying to be proactive, you can set up basically an emergency rent deferral payment plan. Now, this is a custom document that you can make that both you and your tenant will sign. You want to make sure it's documented. And now we would be customizing that for each tenant based on their payment record and based on their need and their situation. In other words, you may want to analyze if you have a tenant that's been habitually late as it was all along, you may not want to do something like this. But for most of them, I think you want to work out a plan, and to figure out a plan that works, you got to be in conversation with them. Now, with that emergency rent deferral payment plan, usually what you're doing then is you're giving them a partial reprieve on rent for the next month or two, and then for the balance of the lease, you're making up that shortfall. If you're going to do that, probably the earliest you want them to start making any extra payments would be June 1. I mean, May 1 would make no sense. And then that may be something you need to amend down the line, like the start date. We don't know where this is going, where everything's going to be. There may be where they're going to be off work for 1 month, 2 months, 3 months. We don't know for sure. So that may be you start off now, maybe making it so that your extra payment starts June 1, but that might be something that you have to amend. Now, also, you want to keep in mind that there may be some tenants trying to take advantage of this situation, saying they're not paying rent, they can't, where in fact they might be able to. In fact, I had one tenant just in the last little bit that called. I figured out they're a teacher. Well, there's no reason they can't be paying rent like they always have, because they're on full salary still. But you need to talk to the tenant, ask a number of qualifying questions, and maybe some of the answers you get, you may want to try to verify. Some you may not. You may be on a relationship basis and kind of look at their history with you. But and then that document, I like to actually have it named the emergency rent deferral payment plan, so it sends the message that it's just temporary and we are working hard to help you.
Thanks, Arlen. So Arlen provided a sample template for that. I also picked up one, I think Wayne and Glenn and a few others of us, Eric Lobo's call last week. So I've got his that we'll post on the resource page as well, but it needs to be modified as Arlen's saying. I'm going to put up on screen, this is a letter that I sent. I have about 40 single-family tenant properties and several hundred multifamily. You would communicate differently with different types of people. So this and several other samples, Garth, you provided the one that you sent out. I know there's others on there. So on the resource page, take it and modify it. This is the kind of language I can use with my single family tenants because I know them well. And I just right up front, I said, I'm on your side. We're going to work this out. And then I do explain everything that Arlen just said. Here's how you can pay your rent. And here's why I can't give you free rent. Now we're mostly Canadians here, I think, but from different provinces, BC, Ontario, Alberta, at least. And our governments have been helping us and in some ways hurting us. Did anybody want to address that?
Well, in Ontario, our premier, it was to get the most votes. He said that there will be no evictions, so we're working with that, and I'm not sure how that will be affecting the payments going forward. But I'm looking at something like yours here and others to see how to respond to my tenants on that. I've had three commercial tenants that have asked for something. I've made a tentative deal with one of them, and that's probably the model that I'll use with the other two. But it may be generous, but it may not. It's I can, if anybody's interested, well, I can tell you about it.
Thanks, Wayne. So in Alberta, I think just on Friday, Jason Kenney announced no evictions, no rent increases, and no late fees. According to me, that's all obvious for a good landlord anyway. But once it's legislated, you start to have people rising up. And I saw even this morning and last week, vandalism and a rent strike for April 1st. Don't pay your landlord, greedy landlords. By the way, if there's tenants on here, there's nothing that we would say as a group of landlords that we wouldn't want you to hear. In fact, we're honored that you'd be here. So we need to uphold common decency, the rule of law, and engage in dialogue, healthy dialogue. But if our hands are tied, how do we do that? This letter was my way of reaching out to them, but I've got several hundred other tenants that might be less sophisticated, and how to deal with that. Any thoughts or ideas from others?
I think I would say going back to what Arlen said about helping your tenants find ways to pay rent. I would add to that, help your tenant find all the programs that are out there that might help them with support, with benefits, with programs right now. And we've done that in our letter and been very, very detailed about it and provided links to all of them. And as we speak with them in the coming days, we're going to check in with them on all those things, and we're going to probably offer to help them sort out if they're not clear on what they might be eligible for, and we're going to become somewhat expert in that and try to help them with that.
Okay, thank you. I see we're just past the half hour. Claude, we're not going to go to this, but there is a website here. I'll give you the link to it. My multifamily partner, Jim Huth, and his son, Liam, have set this up. It's Canada-wide with resources. It will be continually updated as to what those helps that Garth was talking about just now are, because they change daily, and it's very good. So you can, if you jot it down, you can take it now, and but Claude will be helping me get those up, and we'll send an email to everybody that was on the call tomorrow, so you can get access to the materials that Garth provided, materials that Arlen provided, and the materials that people who weren't able to be on this call sent in their comments. So there'll be some links there, a few videos, and a few documents and sample templates that if they help, which, by the way, thank you so much for all of you being here, because that's exactly how I ever get anything done, is looking to others that are in the same situation. I never copy what you're doing exactly. I take it and modify it for my personality and my circumstances, and that's what everybody needs to do. But leveraging good heavens, all the different samples that I've been sent and that I can look at, it makes my job much easier. So I'm so grateful for you to having come in and gathered around me to kind of have coffee virtually. I would like to do this again sometime, but I was just feeling a hunger for sitting in a coffee shop with each of you individually or all of you together. And it's been a blessing and a privilege and an honor to have you here. So I think I'm going to leave the microphones open a bit in case you want to chat with each other. Jeff Stork is on here. He didn't choose to show us his face. He's quite handsome. But he's a commercial leasing representative. Shanna Badri, good to see her. So she owns a bunch of properties and is dealing with all the same things we are. So we've got some investors, we've got some commercial investors, and we've got industry experts. And if you guys don't know each other, you should. You really should, because there's some awesome people on this call. So I'm going to shut up and let you chat a bit.